Good afternoon, everyone. Welcome to today's market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish analyzing the four market indices and how they're behaving, we'll also take a quick look at the U.S. dollar. We'll look at oil, gold, silver, and recently we've added Bitcoin and Ethereum to that, and just kind of see how the U.S. dollar is affecting a lot of different commodities or little areas where the market, where money might flow. And then we'll move on to chart requests. If anyone has a chart request, they can always type it into the chat, and I'll be more than happy to go ahead and take a look at it and see what you are looking at. It could be a chart that you have a trade going on, or it could be one that you're looking to enter a trade, or it could just be a question you might have on a particular pattern. If you like what you see here, you can always follow me on Twitter under the name Stock Darts. Same thing with YouTube under the same name, Stock Darts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, as well as the reposts of these Wednesday market reviews. If you're watching this as a recording, you can always reach out to me on Twitter, and I'd be more than happy to take a look at whatever question you have or whatever chart you're looking at. Other than that, let's go ahead and get started. We're going to take a look at the S&P 500 first through the ETF SPY. And as you can see, we have had a few days of negative price action. Last week we were looking at this, and I mentioned there was a bit of a tug of war going on between the NASDAQ and the Dow Jones, which seemed to have been the two indices that were kind of going in opposite directions, with the NASDAQ lagging behind and the Dow Jones kind of trying to push or pull the market up with it. This was, as we have seen for a while now, kind of a symptom of the general rotation that we have seen in place now for several months, which is one where tech names, particularly those that benefited from us staying at home, have started to really pull back, and some energy names or some industrial names or just names in general that would benefit from a recovery from vaccination of the general populace and people going back out on the streets, we're doing pretty well. So the question was, what was going to happen here now that we were starting to see a little bit of a divergence between some of the indices? And I think at this point it is pretty clear, at least in the short term, that the bears won out, and at this point I think are in control of the short-term price action. I think the long-term price action is still firmly in control of the bulls, and intermediate price action I think is still pretty neutral, which is something we've been expecting. Those of you that visit every Wednesday, you'll know that I've been hesitant about the market, generally speaking, for a few weeks now, as we kept pushing up into highs but really couldn't push past it. And while we were still getting good bullish support every time we'd pull back, it looked like we were stuck in neutral and really couldn't go anywhere. And it looks like at this point we finally got a little bit of a correction, which is often necessary to kind of get rid of some of the excess bullishness or lack of fear that sometimes develops in a market, particularly one that's rallied for so long without any real ramifications for those that continue to kind of hold in the face of supply or distribution. And so we're finally seeing a little bit of selling pressure, and the question of course is going to be, where are we headed, and at what point do we find support, and what is that going to say about the environment that we're in at the moment? And I think those are questions we're going to try to answer today. Of course, these answers, there's only so much we can give you, because in the end the market's going to do what the market wants to do, and it'll be up to us to kind of gauge what the potential scenarios are that could play out in the next few weeks to the next couple of months, as we are heading into the summer months, and the market could end up sort of stalling out here and giving us a consolidation range that might take a while to kind of play out. But we'll get into that as we go through all four of the major indices. As far as the S&P 500 is concerned, we're going to look through just SPY. We'll see what we can kind of gauge off of that. Sam, welcome. Good to see you. I have not talked to you in a while. Glad you came in here. Thanks. I am doing well. I hope you are doing well. I hope you're still doing good with your Forex trading. Hopefully you've branched off and done some cryptocurrency trading as well. That has been a very good area and a very profitable area throughout this year and sort of maybe the end of last year. But hope you're doing good, and glad to see you in here. And like I said, well, if you have anything to add, feel free to type it into the chat. I'd be more than happy to interact. But going back to the S&P 500 and looking at the ETF SPY, you can see that we lost, in the short term, we lost a decent level here. But this was kind of expected, and what we were looking at really was going to be the interplay between the 20-day and the 50-day moving averages. We discussed this last week, and this is a pattern that we discuss quite a bit as it plays out very often, particularly in trending stocks, where you eventually lose the 20-day moving average. And I mean, it's a function of math. It's going to always happen at some point or another. But what tends to happen very often is that when you lose it, you come down and you test the 50, and then you chop in between the two. And so that seems like where we're headed with the S&P 500 is to come back and test the 50-day moving average. And then that's when we have the first real test as to what the bulls are going to do and whether they want to show up and defend price action or whether they're still hesitant. And I believe that there's room further to the downside to come down to maybe about 400 or just below that, around 398, 397. And that is really the first really strong support level that we can look at. Now, we'll take a look at this, relatively speaking, the same sort of support level as we go through the four major indices, and we'll see that within using that reference as a reference point, the price action is a pretty different place depending on which index you look at. But as far as the S&P 500 is concerned, we're still pretty decently above it, and we're still coming up to test the 50-day moving average. And usually on a trend this strong, when you test the 50-day moving average, you usually initially get a bounce. However, as you can see, we've tested the 50-day 1, 2, 3 times. This time we actually tested it twice, but we'll just consider this one test. And so the more often you test the moving average, the more likely that it will eventually be violated by the price action. Not saying that's going to necessarily happen here. I think it's probably a good bet that we try to bounce and come up and test the 20, and then from there we'll decide whether we're going to pull back down or not. But the key is, in my mind, is not really the 50. It's this area around 398 to 400, as that was the kind of dividing line between when price action got really bullish and when we were getting a little bit more negative and a little bit more volatile in basically the end of February and most of March, where we were starting to really challenge the trend that we had in place, and we're looking like we were going to transition towards a sideways market, and a couple of the indices actually did sort of do that. And so that's kind of the real critical area, is if we fall back below 400 and start trading back in this range, I think it's a pretty clear indicator that we are probably going to shift towards a more neutral market environment and start to really trade sideways. Now, this is something that I've kind of had in mind was going to happen anyway. But until it plays out that way, we just have to kind of keep playing the market under the assumption that it's still in the same bullish trend. Because a lot of times these trends persist longer than you expect. And a lot of these transition zones where you have a bullish market that transitions towards a sideways market, it doesn't typically happen within the span of 1 or 2 candles. It's a transition zone that happens within the span sometimes of weeks to months, where you start to see the price action erode little by little. And what ends up happening is you have some bulls that didn't get the memo on the first pass, maybe on the second pass, maybe on the third pass, but eventually there's enough people that kind of head for the exits where you don't have enough buyers left to kind of support the price action, and that's when the final guys kind of get the memo and then maybe don't hold, and then you start to finally get these resistance or support levels broken. And so we're still in sort of that transition where there's still a lot of people that are very bullish in the market, but we're starting to see more traders that are a little bit more fearful. I don't want to say outright bearish, but definitely a little bit more hesitant to buy at the levels that we're at. And that's typically how it starts, right? You start off with a little bit of not necessarily outright bearish attempts to short, but more along the lines of maybe not wanting to buy or maybe selling as you get to these levels and taking profits and then waiting for a better place to go ahead and re-enter where you consider value to be. And so it looks like we might be in one of these transition states, but it could also just be part of this regular trend that's been developing. And it could be that we hit the 50 and then, I'll project this trend line out, although I don't think this trend line, as I've said many times throughout the last year, is that critical on the S&P 500 chart. I think the 50-day is really what has been kind of demarcating this trend. As a matter of fact, you can see for the most part, it's been the 20 and the 50. It's the moving averages that have really been kind of forming the channel that we trade in. So we'll put this trend line out there as it's still a pretty good visual representation of what the trend is on the S&P 500. But I think the key right now is going to be the 50, and then maybe a little bit below it as we kind of take that shape and see whether the buyers step up there or not. If they don't and they come back down and we have to challenge this 400 area, then I think that becomes a much more critical retest and one that becomes important as far as figuring out whether the buyers are willing to step in here or not. So with within the rest of this week, right? We got obviously the rest of today, then just Thursday, Friday, but between the close of this week and the start of next week, we'll see what happens as we kind of come in and test these areas. For those that are looking to buy a bounce or buy a dip, as has been very profitable throughout the last 6-7 months now, we're not ready yet. You still want to wait for us, maybe not necessarily to hit these support levels, but we want to see reversal candles, and we're not seeing that yet. And I suspect we won't see them until we hit these support levels. So if someone is looking to buy a dip or someone looking for a reversal back to the upside, I think that we've actually seen a pretty decent shift in market character here. And I think at this point the market is looking for buyers, which means it's pushing downwards. Throughout the last few weeks, the market was looking for sellers, which meant it was pushing upwards. And I think we finally found that, and now we've flipped towards looking for buyers, which means that there's a decent chance that we need to push further down until we get a convincing show from the buyers that say they're ready to step in and they think that we've hit value. And so I don't think we've hit that yet, and I think it might take a while before we see that. I don't think it's necessarily something that we're going to see in one candle. Now, that being said, what can we project out of the S&P 500 here? What kind of behavior patterns can we think could possibly happen over the next couple of weeks? So let's go ahead and go over a couple hypotheticals. First thing we're going to do is we're going to say, let's say we come down and test the 50-day moving average. What we're going to do is we're going to color this white just to show that it's a little bit different from my normal yellow trend lines. So let's say we do this, right? So the next step is what happens if we do bounce, right? And so typically what happens in this scenario is you bounce up to the 20-day moving average, and then you stall out, and then you come right back down, you test the 50-day again, and then from there, that's the key, right? Do we bounce again and then finally make our way back above the moving averages? Or do we break down and head back towards lower levels? And like I said, this is more likely than not what will happen up to this. I'm not going to point. This will be the deciding factor, but I would say the more likely scenario that we see over the next week or so is going to be something like this, right? Now, the other scenario would be that we come down and test this 400. Now, if that happens, we probably don't come up and test the 20. We probably really get stuck down here. And then that gives more of a chance for us to really come down and break through this key level. So this would be the other probably more likely scenario of the two. Then, of course, there's one scenario where we just continue to head down, and there's another one where we just continue to head straight up, and we find, one candle is all it takes to bounce and go back to new highs. But I think those two are probably less expected as far as if you just go ahead and assign everything probabilities. The more likely scenario is that we do pull back in the next couple of days, and really the key is, do we find support at the 50 or do we find support down here at 397 or so? Clearly the 50 is the more bullish scenario. The more bearish scenario is 397. However, I think in both situations we will get an initial bounce, and then likely off of that initial bounce another selling point, and then from there I think that's when that's what's up in the air, is what happens after that, and that's what's really going to be the key. So if you're looking to trade, I think that again we're still in a scenario where we want to be a little bit more patient. It looks like we're going to have to wait at least a few days, if not another week or so, before we get a definitive idea of where we should establish support and whether the buyers are willing to go ahead and step up and defend that. Which means that buying right now, you're probably going to buy early, which means that you're going to expose yourself to additional volatility or additional risk waiting for these scenarios to play out. And so, in my mind, it's not really a good time right now to go ahead and try to get too aggressive looking for a dip yet. And on the flip side of that, I don't think it's a good idea at all to sell right now. This is something that we've been going over for a few years now at least. We're in such a strong secular bull market that it really doesn't pay to try to call shorts in this type of environment. I've seen on my social media feeds a few different types of traders complaining because their shorts haven't worked yet. And I think the issue is that if you really step back and take a look at the longer term picture, we're just in such a strong market that it just is not a good idea to short. Now, yes, we had the one coronavirus as sort of a black swan event, which was a really good opportunity to short. But other than that, we've had a few different areas where the market maybe swings down, but it's pretty volatile and there's a lot of buying in there because there's just so much demand because of the eroding value of our dollar and the fact that capital has to rotate to one of the few areas that can give us return. There's just too much demand, and every time that you think you have a good short, it ends up being messy because there's just too much buyers that are going to step in, and even if it's only one or two candles that emerge, sort of like what happened here, it's enough candles to really throw traders off and to get them to stop out of their trades, and they don't really even get the short trade that they wanted. And even this sort of scenario, you're looking at a short trade where you're maybe getting 20 points instead of a long trade where you're getting 80, 90, 100 points, right? And so it still benefits us to look at the long side. It's still where the better probabilities of success are. It's still where the better risk reward is. So for now, I would say still don't try to get cute and try to short this. Even if you did try to get cute and short this, risk reward is terrible at this point as it's already dropped quite a bit. So in my mind, we just want to wait for a better opportunity to buy dip and for the market to tell us what it wants to do next, whether it wants to continue this trend upwards or whether we're going to shift and break this channel and start shifting trading sideways like the NASDAQ has already done and like IWM has already done, which we'll get into shortly. Alright, so the key levels, if you're watching, I think we've already outlined them, but they're pretty clear. The first key level is the 50-day moving average, which is right now is right around 404. The next key level to the downside is right around 397, which is this red trend line, which again separates this volatile sort of chop that we had for a few months or a couple months, as opposed to the more the cleaner, smaller candles as we really started to take off again. To the upside, there's a very small, or there's a level here at 411, which kind of is important in the short term. But I think more critical will be what we do with the 20-day moving average. And then obviously highs, which I think are off the table right now. I think what we need to concern ourselves with is the 20, the 50, and then possibly down here at 397. Now, if we take a look at the NASDAQ, we'll see that the NASDAQ has already kind of broadcast what it expects the rest of the markets to do. If you take a look, with the S&P 500, we could be maybe here, right? Now, it could be that we're still here and there's still a little bit more rally to go. But generally speaking, the NASDAQ was well ahead of the curve, and it had a nice clean rally, and then it kind of broke down and started trading sideways. Now, these sideways, when you break these channels and you start trading sideways, as is pretty clear off this chart, that doesn't necessarily mean it's the end of the road for the bulls, and it doesn't mean it's a market top. It just means that that particular rally has finally reached the point where it can't sustain itself any further. And so we chopped around sideways. And again, this is very similar to the S&P 500. We had a real big threat of a market maybe heading lower. But eventually that resolved to the upside. And we got this nice bullish action that pushed to new highs. But as you can see with the NASDAQ, it wasn't able to sustain that again. And we started to see rotation out of tech. There was a little brief rotation back into tech as tech had gotten a little bit of extra value as it had pulled back during March and April. And it became a really good buy, and so it kind of swooped up into earnings. But as you can see post-earnings, despite the fact that a lot of FANG stocks actually did okay during earnings season, the tech names are finally starting to see money rotate back out. And as you can see again, they are a bit ahead of the curve if you consider the tech names to be a leader in the market, and they are leading down right now. You can see we already had the scenario that I outlined for the S&P 500 has already taken place with the NASDAQ, and that's that you lose the 20, you test the 50, you come right back up, you test the 20, then you come back down. And at that point, that's the critical point. What happens next? Do you try to resolve back to the upside, or do you go to the downside? And as you can see clearly with the NASDAQ, it broke to the downside. Not only did it lose the 50-day, it lost this really important level, which we were discussing as far, relatively speaking, on the S&P 500, which was the top of the range that we spent March, the end of February and most of March in. Which means we are right back into this volatile area where the sellers were more in control than the buyers. So looking at the NASDAQ, this is a much more bearish picture in the short term of the price action of the overall markets. Now again, if we just flip to the weekly chart, it's still very, very bullish in the long term. And so I don't think that we're at a point where we could say we're at a market top. I think that's a little, we're jumping the gun for that. I think at this point what we can say is that it might be that we need to spend more time trading sideways, and it might be that we need to maybe have another market environment for the rest of this year where we spend some good time really trading sideways and trying to figure out whether this is good value or not, and whether there's enough bulls or bears to defend whatever levels we're kind of dealing with right now. And as you can see, we went through one of those stages from 2018 through most of 2019, and eventually we found enough buyers to really push us forward. And it could be that we need to try to transition and do another one of those things. You can see we've had a pretty good run up, even with the interruption with the coronavirus. We've had a very strong markup phase in this market, in the Nasdaq, and it seems to be transitioning towards one of these broad corrective ranges where we don't necessarily top out and head all the way back down to these levels that we left behind back in 2019, but maybe we develop a broad range and trade in the channel, and take a little while to take a breather and really figure out what is considered value and what's not considered value. And so, in the long term, it's still very bullish, but as you can see in the short term, it's not that bullish. It's actually a little bit bearish, where it seems that we've found the short-term top, and now we need to come down and test exactly where support is and where buyers expect value to be found. And it could be that we're going to have to come all the way back down and test the bottom of this range that we spent March and February in, or it could be that we head even lower, or it could be that maybe we kind of find support up here at the 300 area, maybe at the 200-day moving average. And so I think that's up in the air right now. But what is clear is that the Nasdaq is leading down. And again, you can see down 2% today, whereas the SPY is 1.5, and the others are down 1 to 1.5. So the Nasdaq is definitely leading down. They're the ones that have the most technical damage to their chart. And so this is probably the area that we need to find support on before we can expect the overall markets to bounce. And the key is going to be, where do we find that? And unfortunately, it looks like there's definitely room for us to head further south. Now, the first line of defense is right where we are right now, which is this breakout point from the end of March, where we really started to rally. Even though this area here, this 324, was kind of the flip where we left this range and started a new one, as you can see, the bullish move started when we broke through 316. We're right back to that. That's going to be the first line of defense where the bulls are going to try to step in and support price action. If we do find buyers here, more likely than not, we just form a bear flag and probably resolve to the downside, unless the other indices respect this relative level and bounce, in which case then maybe we'll find a little bit of a bear flag here and then we bounce. But more likely than not, we print a little bear flag or a couple days, and then we head further south and we test this range down here, maybe around 308, which is one of the areas in this channel, and also kind of where we found support before we really had this little false breakdown, and was the last area that we found support before we rallied. So we could take a pit stop around 310, 311, and then maybe head down to the 200. So those are the kind of levels that I'm going to watch. Not really sure where we'll find support to stabilize the price action, but like I said, temporarily we probably find support here for today and maybe tomorrow. More likely than not, we're going to have to come down and flirt with the 310 to 305 area and see if the 200-day comes up to meet price. If we lose the 200, then we probably come down and test this area here. But I expect that to be short-lived. I wouldn't expect that to be something that holds up, that we break down and really accelerate to the downside. I think that at this point, from what I've seen out of the price action, this is a run-of-the-mill kind of pullback. I don't think it's anything too drastic where we need to be worried about the really losing the floor on the price on the market. I think it's more along the lines of trying to develop exactly what the range is going to be that we trade in. And like I said, right now what the market is doing is it's looking down. It is exploring to figure out where buyers are. And in order to do that, it needs to push the envelope and really push down and see where buyers are willing to step in and defend price action with any kind of real sign of conviction. And so that's what we're looking for here. Now, to the upside, let's say we do find buyers. Let's say the Dow Jones yanks us back up, or the S&P 500 turns around. Well, at this point, the Nasdaq has broken through a pretty critical level. So I expect this to be a pretty good ceiling in the short term. This 50-day moving average and this area right around 324. So it would need to get back above that in order for us to kind of feel like maybe there's still more bullishness left in the market and maybe we want to make another run at highs. However, more likely than not what happens is even if we do bounce, it's going to get stuck around here. The 20-day is going to come down and push price action right back down, and it's going to cross through the 50s. So generally speaking, this is not a very good looking chart in the short term for the tech names. We'd have to go pretty far back before we saw similar price action, and that was what we saw back here towards the summer, the end of summer of last year, where we had this big run up, and then we kind of we spent, as you can see, what is that, 1, 2, 3, 4, maybe 3 or 4 months trading sideways before we resumed our rally. And as you can see, the moving averages had kind of crossed, but in this particular scenario, it still kind of stayed bullish because when we finally got that cross, the price action had already rallied to kind of support it and maybe make it push right back up. So, you know, this is kind of critical. We're entering the same sort of state where the market is going to start trading sideways, and the response of the bulls as we hit support is going to dictate what happens next. So we'll see where this goes. Like I said, I think of the 4 indices, this is one of the more bearish ones in the short term, and it'll be interesting to see whether the tech names can get their act together and start to kind of recover, or if there's more room to the downside before we finally see where the buyers step in. Now, the one bright side for the NASDAQ is so much of the Qs in particular is tied up into Facebook, Amazon, you know, the FANG stocks. And these are the kind of stocks that tend to have buyers step in anytime there's a real drop. So we'll see what ends up happening here. As you can see, I'm going to go through them real quick, and you can see that they are, all of them doing the same thing. They're kind of breaking down. They're coming down, testing moving averages, testing the bottom of the ranges, and we'll see what happens and where this leads further. The one thing I do want to point out is something we discussed and we explored quite a bit, maybe about a month ago, which is the idea that the NASDAQ was leading the overall markets, and more so than that, these FANG stocks were leading the NASDAQ. And as you can see, Amazon transitioned towards a sideways range and has been basically consolidating for about almost a year now. And so if you're looking at what we can expect out of the overall markets, I think Amazon has already kind of broadcast what it thinks that we should be doing. You know, again, Amazon was probably one of the biggest leaders during the beginning of 2020 and during the recovery process of the coronavirus. And as you can see, as we headed towards the end of last year and the beginning of this year, it has basically just traded sideways. You take a look at Facebook, and it kind of did the same thing, although it did kind of break out here at the end. Apple, again, has basically traded sideways for about a year now as well. Netflix has also been just basically trading sideways. And Google a little bit different because it did break out and has had a pretty strong transition upwards during this year. But some of the key leaders, particularly Amazon and Netflix, which were sort of the 2020 kind of COVID stay-at-home darlings, they've already transitioned towards a sideways price action. And that's what we're starting to see develop on the NASDAQ. And so it could be that if we follow suit and follow what those two leaders are doing, it could be that we spend another few months trading sideways, and maybe even all the way up into the end of the year. So that's something to keep an eye on and to kind of gauge how you want to go ahead and start to structure your trading process or approach how you're going to look at trades in the next few months. You might want to keep an eye on that and see whether we start to mimic that pattern across the board or not. And I think that that's where we're headed, but I'm not 100% convinced yet, which is why I still kind of am trading. Well, even if we transition sideways, I'd still be trading to the long side and just buying dips. But we're still in a transition zone where we'll get to the Dow in a second, where we are still seeing some bullishness in certain pockets of the market. So it could be that we have the NASDAQ trade sideways, but we still have some of these recovery names, some of these energy names, some of these travel names that are going to still be in a bullish phase because they are only now starting to get capital infused back into them. So, you know, we're in a transition state. The waters are muddy, and it's going to be up to us to kind of figure out where we want to trade and what we consider to be the overall themes that are affecting the market. Clearly, tech, like I said, is transitioning towards a more sideways and broad corrective range, but we're not 100% seeing that yet everywhere. If you take a look at the Dow Jones, yes, the last 3 days are pretty bearish, and looks like we topped out in the short term and really couldn't sustain this breakout that we tried to have. And like I said, this is kind of a tug of war between the Dow and the Nasdaq right now to see which one's going to lead the markets or try to pull or pull each other up or down. But generally speaking, the Dow Jones is still holding up pretty well. It hasn't broken any key levels. It lost the 20-day moving average, but it hasn't hit the 50. It still hasn't lost the short-term support level around 335. And we're still pretty far away from anything down here, which is the February-March range, where it didn't even really, it really just spent like a week going sideways with volatility, and then it started to rally. And so there's a lot of room for correction here and still maintain this bullish trajectory. And it could be that capital is going to continue rotating or staying in these down names, which it probably doesn't bode well for the overall markets, but would bode well for this and would give us maybe some decent opportunities to focus on just the Dow components and see if we can get good returns off of that or off of other names that are following this theme, right? And so this is going to be one of the areas that we need to kind of watch and see what happens as the Dow heads into support, whether it makes its way back to highs while the Nasdaq continues to chop back and forth, or does the Dow follow the Nasdaq down and start to really lose this pattern here and this trajectory that it's established for itself. And so, we're at a pretty critical point here on the DIA, or on the Dow Jones, which is what's going to happen here as we come down and test the 50-day. Are we going to chop and then try to break this channel? On the Dow, this channel is a little bit better formed. There's still more room for us to come down and test it. Like I said, I think the moving averages are still the key, more than the trend lines that are kind of defining the channel. And we'll see what happens if we hit that level. But if the Dow does break this channel and start trading sideways, then I think that's going to likely mean that all the markets are done rallying, and that we will definitely spend summer trading sideways, more range-based trades, which will likely mean more volatility selling, a lot more short-term profit-taking, and a lot less trailing stops. And so that's kind of what we're trying to get at here, right? When we analyze these markets, we analyze what kind of environment we're in, we're trying to figure out what kinds of trades we want to take. And like I said, because of the bullish trajectory that we have been in the long term, we still want to buy. We're not at a spot where we want to sell, right? So the question then becomes, how do we trade this? If we're going to trade sideways, that means we want to go towards more neutral trading. I'll address that in a second, Sam. So if we are in a range-bound market, that means that we want to maybe, obviously, what does it mean to be in a range-bound market, right? That means that there's going to be more choppy price action. There's going to be a lot less sustained moves. So how do you go ahead and change your trades? Well, for the first one, you don't try to trail your stop too far. You get a lot more of just point-to-point trading, where you just take your profits as you hit profit targets. You don't look for outsized returns. You just try to make your 2-to-1 or 3-to-1 and leave it at that. It also means more covered call trading, more iron condors if you're into options, that sort of stuff, and a lot less buying calls. For people that trade that buy options, a lot less buying directional options, because those are going to tend to really struggle when a market trades sideways. Okay. All right. So Sam, you said you're not much interested in cryptos. You have a micro long on Bitcoin running since 2018, which has worked well, and you have not been trading too much over the last few years, mostly busy with your family, job, and with reading. It's good to see things are working out for you. Good to see your job has been doing well for you. I don't think you need to worry about that Discord channel. It's kind of dead right now. No one really goes in there anymore. I'll send it to you anyway, but it's kind of dead. But you can always DM me on Discord anyway. But I'll send it to you when we're done today, okay? And I'll cover cryptos in a minute. I still think that's, if someone is actively trading or even investing, I think that's an area that I don't think it can be ignored anymore. But we'll get into that shortly. So with the Dow Jones, like I said, I think that we want to see what happens here as it really does it transition towards a sideways market, or does it try to hold this rally. And I think if it holds this rally, then I think the rotation game is where we want to focus, and we want to focus on recovery names and names that are benefiting from our economy continuing to kind of open up and recover. So that's going to be something to keep an eye on. Now, the key levels, we're at one, which is 335. The 50-day around 333 is the other, and then maybe a little bit low at around 330 or so would be the next. As you can see, there's a decent gap here that hasn't been filled, right around 331, and I suspect that this would be kind of the major support level that we would need to really defend for the bulls. That would likely be exactly where the decision would have to be made, whether this channel is dead or the trend is broken, or whether we're going to continue rallying upwards. So that's going to be a critical point. However, I think the Dow Jones will likely find support prior to that because, again, it is the strongest of the four indices at the moment. All right, and then the last one we want to look at is IWM. And as you can see, just like the NASDAQ, the small caps have been trading sideways for a while now. And as you can see, it's actually not a bullish chart at all. Matter of fact, we've got kind of what could be even interpreted as a head and shoulders developing. If you just take a look at what we've done, maybe in this range, and you take a look, we had this nice impulse up to about 230, then we pulled back, found support right around 210 or so, came up, broke to new highs, and then pulled back and found support right around 210. And so it gets messy here, right? Because this is not quite the same, but as you can see, we made our way right back up to this level that we failed at, and now are starting to make our way back down. Now, there were a couple of impulses, so this is not technically really a head and shoulders, but I think the underlying psychology is very similar, where we have tried to push through our previous levels and have failed. And at this point, we've lost this trajectory that we had built up. You can see the moving averages have all curled up. We lost them a long time ago and are pulling back down. So again, this is not a very bullish chart in the short term. Matter of fact, it's actually kind of a bearish, or it's a pretty bearish chart in the short term, considering it looks a little bit like a head and shoulders. And so the key here is going to be what happens when we come back and test 210. I think that's a magnet that's going to have to be tested. So even if we bounce in the next couple of days, we're likely to going to come up and test the moving averages and then head right back south. So as far as small cap names are concerned, I would be very careful as far as trying to get in early on this. Now this kind of flies in the face a little bit of the rotation trade, because a lot of recovery names are small cap names, and they're struggling as well. So it's just a few Dow components that are really holding up the Dow Jones right now, and so we still need to kind of go in and tease out exactly what's going on. But there are a lot of small caps that are struggling, and you can see clearly that the overall price momentum is kind of deteriorating to the point where we can no longer say that we have an intact rally, and in fact have already transitioned towards a sideways market, and might even be threatening to kind of head lower and maybe step down a bit and really try to flesh out exactly where support is. So this is another key area to watch to figure out what's going on with the market and what's going to happen next. I think it's going to be one of the leaders to the downside, as in, if it sells off and breaks these levels, it will likely be felt across the board. And so the issue now is going to be, do we find support at 210, 209? If so, then that lends itself towards this theory of we're trading sideways. I don't think 233 to 208 is a broad enough range for the type of chop that I'm expecting if we're going to trade sideways for the next year or so. So it could be that we threaten lower eventually. However, I think there's a decent chance that we do find support when we test this and we try to bounce right back up. And so that might be a good buying area, but again, it will depend on how the bulls go ahead and defend that. And I think to the upside, this is going to be a very big wall. The moving averages and this triangle that we just failed from, this 224 is going to be critical. I don't think that we're ready to break above this, and I think it's going to be a while before we do. But if we do break above it, then that's a pretty bullish sign, and likely means an attempt at new all-time highs. And so that will be the area. If you're bullish still, or if you're looking for a strong momentum, we're gonna have to break this and get on the other side of these trend lines. And like I said, I don't see it in the cards right now. I think that we're gonna head lower, and I think we're gonna test some of these key areas here, and then from there see what happens. So if you look at the markets just as an aggregate, there's really only one out of the four indices that looks even moderately bullish right now in the short term. Most of them do look like they're hinting at more selling. I will say again that we are kind of transitioning into this, and so there are a lot of bulls that are still trying to defend this and trying to buy, and that could lead to a rally or a couple of green candles that maybe shake some people out. But I'm not ready to get fooled by that. I think that we need to test a little bit lower before I'm ready to say that we're ready to bounce, or that I'm more confident in buying the dip right now. So if I see a green candle today or tomorrow, I will likely ignore it. It could be that we do rally right back to highs. And if that's the case, I'm okay with missing it because I don't consider this to be a high probability area for that to occur. I think that would be a pretty low probability scenario. And so I'm okay with missing that if that's what ends up happening. I think the more likely scenario is that we do head lower and test some of these support areas that I pointed out across the board. And so that's what I'm going to be doing. And like I've said over the last several weeks, I have already been kind of sitting on my hands. I have not been trading very actively at all as far as directional swing trading is concerned. My main focus was on some earnings trades during the last couple of weeks. And as I've stated before, quite a bit with cryptocurrencies, which have been giving me a lot more returns and cleaner moves, even with some of the volatility that has come into that space as well. And we'll get into that in a little bit. But first, let's take a look at the US dollar. We'll look at oil, gold, and silver, and then and see what's going on. So as you can see, the dollar continued to kind of deteriorate, and it's only with today that we finally got a little bit of a bounce. But it did head all the way back down and test what is a pretty important support level on the UUP index. Probably a good sign that we did get a little bit of a bounce. We don't really want the dollar completely getting trashed. However, I don't think that there's enough here to really put any belief in the fact that we're ready to bounce and head right back towards the previous levels. I think more than anything, this just shows that we needed a relief bounce before we broke these lows. We're probably going to head back down and retest them, and then we'll see what ends up happening. I think at that point it'll be a little bit more important. If we look at the euro, US dollar, again, it's going to be an inverse of that. And as you can see, the euro rallied right back up again to a mirror image of the UUP index. Because again, this chart is based in euros, where euro up is good for the euro. And as you can see, the euro climbed in price relative to the dollar. But just like the UUP index, we've reached the point where the dollar kind of had a little bit of a rebound. And so now the key is going to be, is the euro going to continue to put pressure on the dollar and break right back above this 121? You can see the last time it did so, it couldn't sustain it. And so this is going to be an important battle zone here as far as the euro and the US dollar are concerned. It's going to probably have implications across the board, not just on commodities, but maybe even the stock market, and most certainly on gold, silver, and probably even some cryptocurrencies. So this is going to be an important area to watch and to see what happens. Like I said, if the euro really breaks out, then that's probably good for the market. However, if the dollar starts to really put pressure and starts to really start to rally again, that might put more pressure on our stock market. So that's something to keep an eye on. If we look at the US versus the yen, this again is probably the one currency cross, and we discussed this last week. For those of you that are Forex traders, this was a really good buying opportunity, trading the support zone right around 108.5. And as you can see with today's candle, we finally got that move. We got the breakthrough this descending trend line. And it looks like we're probably going to try to sustain a bounce back up towards these recent highs. It's already reached the spot where probably some profit taking should be had, considering this level of resistance up here. But again, this is the more bullish chart as far as the US dollar charts are concerned. And this is a pretty good invalidation of what was also a little bit of a head and shoulders type of pattern going on. But as you can see, we've kind of made our way back up, and showing that there is some US dollar strength. But then in direct contrast to that will be the US Canadian, which just keeps breaking down as oil continues to gain some strength. this has been a very steady downtrend, and any Canadian dollar bulls have been very happy with what they've been seeing, and I'm sure that they've made some good profit. I actually I feel like maybe I should have participated in this a little bit more than I have, as there have been some pretty steady trends that maybe I kind of missed out on, which is kind of rough because every Wednesday I basically say the same thing, that the U.S. Canadian keeps pushing down on the dollar. Um, but you know, I've had returns in other areas. If we look at oil, oil's making its way right back up to 66. Now, if you are in the U.S. Canadian trade, what you're watching for is for oil. If oil loses this trajectory that it's starting to develop, that would be when we would see the dollar put some pressure. And so this is basically what's going on here, right? You had the nice move up to the 60s, mid 60s. We broke down. It got a little volatile here. However, we had what we mentioned, right? That you break the 20, you test the 50, you chop back and forth, and then eventually it did a little bit of a false move and then kind of broke back out towards the upside. And at this point, this was a pretty good indicator that the bulls were back in control of oil. And as you can see, it's kind of made its way back up. And like I said, this is a reflection of increasing the expectations of increased energy demand, which would mean higher prices to support that. And the big key now is, of course, does oil have enough momentum to push past 60s, the 66 area, and head closer to 70? And we'll see whether that's going to happen or not. If it doesn't, well, now we understand we've got this trend line, we've got the moving averages, and if it breaks below them, it'll probably head right back down and test the 58 area or so. And like I said, that would likely mean, if we break this trajectory, that would be probably a good indicator that the U.S. dollar is ready to rebound versus the Canadian. And it would also be a sign that oil-related stocks are probably going to correct and head a bit lower as well. So, anyone that's in trading anything related to those spaces, watch that area. All right, and so the last thing we are looking at is, actually, wait, I didn't even look at gold and silver. Let's look at gold and silver first, then we'll look at Bitcoin and Ethereum. So gold actually had a very nice move up. As everyone here knows, or anyone that watches this regularly, I have been completely off of this trade. I'm completely fine with missing this move here because, again, gold and silver have behaved so poorly over the last year that I don't really want to be involved in an equity that's just kind of chopping back and forth and is really kind of in a downtrend. So nice move. It was a nice bull flag and a nice kind of movement off of that. And both of them have done good things and maybe are coming up into some resistance areas. So if you actually tried to trade those, this might be a spot where you don't want to take partial profits. However, keep an eye on the U.S. dollar, as the U.S. dollar is threatening a big breakdown. And if it does have that breakdown, then we will likely actually see gold and silver maybe start to resume an uptrend. And so, keep an eye on the U.S. dollar, see what it's doing versus the euro, and watch this area here around 24.20 on the UUP index, or if you're watching the euro US dollar cross, this 121.7 or so. If we see a break past it on the euro and a breakdown on the 24.20, then that will likely mean a pretty strong move on gold and silver, and actually probably even in the stock market, and probably across all commodities. And a lot of the assets there seem to be in a little bit of a bubble right now. So keep an eye on that. All right, and so now the last thing we want to look at is Bitcoin and Ethereum. So Bitcoin is actually still in a little bit of a negative looking chart. It's, as you can see, it had a nice upward trajectory, and it kind of tried to break past it into new highs, and it failed. And since then, it's been really stuck trying to get back above this 60,000 mark. And it's really kind of faltering here. I have this trend line drawn as slightly descending, but it could just as easily been established here, which is basically 60K, right? And either way, when you look at it, this is exactly what we're struggling with. And as you can see, we've lost momentum again, right? And so Bitcoin is really struggling to kind of break through what has become a pretty important barrier for it, um, which would bode poorly for other cryptocurrencies if Bitcoin were to break down. However, we have a very, very big divergence here with Ethereum just blasting off, just taking off, and basically doubling in price within the span of a few weeks. And typically, smaller cryptocurrencies, they run up with Ethereum. So we have a very big divergence here. And I suspect what's going to happen is Ethereum will pull back. And the question is, will Bitcoin bounce off of that? Or will Bitcoin pull back with it? And if that's the case, then we will see many cryptocurrencies enter much stronger corrections. As you can see, cryptocurrencies right now, you can see if you look at my watch list, there's a lot of red and there's a lot of green. There's a lot of back and forth going on here, but there have been some pretty nice moves, and there's still some charts that are setting up and still giving us some pretty decent looking charts, or trading opportunities. And so, we have a lot of potential returns here. You take a look at something like this one, like Matic, right? And so, Sam, this is the one thing I would say. I know if you're not trading right now, then obviously this is something you don't need to pay attention to. But I know a lot of traders that I've interacted with in the past, which are very similar to you. Kind of established already, have jobs, have families, are still kind of working on their trading, and so they're very hesitant to trade something as volatile as cryptocurrencies, because of course there is potential for serious downside on these types of moves. However, I feel like the upside on them is too good to pass up, and so this is why I've made so much potential trades, or why I've focused so much on these and have done very, very well, is because something like this one, like Matic, right? I've been in this thing since it was in the 20-cent range, and look at it, it's at $1.15, and it's done so well for me that I'm okay with these big pullbacks because I've already taken enough profit and I've had enough of it work in my favor. Something like Loopring, which was kind of scary recently. It went from 74 cents all the way down to 40 cents. But then look at the move it's had over the last couple of days. And so if you could take advantage of this, and the way you have to manage this is through position sizing, right? This is something that you've taken mentoring with me in the past. You've taken some of the workshops we've had before, and you'll know that when you're trying to manage your risk on trades, it's not always about putting in a stop, right? Sometimes it's about position sizing and understanding how much capital you're putting into a particular trade. And so what you want to do with some of these is you want to just manage your position size. It's not just a matter of saying, well, I'm going to put a stop right here at 130, because when you have something that's this volatile, you have to give a room to kind of go back and forth. And so what you do is you manage it through position sizing, and you understand there's a certain amount of capital you're going to put into it, and you have to be comfortable with understanding that you could lose a good portion of that capital, but also can double that in just the span of a couple days. And so it's important that it's the same basic procedure that we do with trading stocks, but you just have to change your mind frame a little bit and understand, just use a couple different ways. If you change another one, if you take a look at it, it was basically trading at just 1 or 2 cents. And it's 20 cents doesn't sound like a lot, but when you consider that it was you could have held it when it was around 2 or 3 cents, those kinds of returns are just ridiculous. Sam, I use Coinbase for a good portion. So my Coinbase portfolio is basically this top area. It's a I've got this one. I closed out NU, but I've got this one. Loopring is a Coinbase coin. Algorithm is a Coinbase. I have Matic on Binance, but it's on Coinbase as well. A few of these coins that I have, they're Coinbase coins. Maker's another Coinbase coin that's really good. I don't think the spreads are that much. I don't think the spreads are that bad right now. Like I'm okay with some of even the market prices you get on them, just because it gets erased so fast with the moves, But Coinbase and Binance are my two main exchanges that I use. And I'm fine with Coinbase. I haven't had an issue with it. I don't really care that much about the spreads on it. As a matter of fact, I often don't even go to the. I don't even use Coinbase Pro to trade like a regular. A lot of times I just convert these from one to the other. I don't even really care what the market price is because it doesn't matter. It gets erased within the span of a day. One candle and that market, and that spread is gone. So, but it is what it is. One thing I will say, Sam, with Coinbase, let's say, if you're in a position where you still don't want to really risk a lot of capital, just do Coinbase lets you earn the coins for free. It's not a lot of money, but, just do the tutorials and get $5 of one coin or $3 of another coin and, convert them to something you like. And so, I've actually kept track of the Coinbase coins that I got from their little earnings, and it's like $30 of coins, but it's already worth like $200 worth because just stuff they give you for free, and so it's something that you can still do, and kind of slowly build it up that way. I am not using Robinhood for it. However, different members of my family do. My brother, who is a much better trader than I am, he uses a lot of the same exchanges I do. He uses Interactive Brokers, he uses Coinbase, he uses Binance, but he also has Robinhood where he manages some of his daughter's stuff, or where he was using it for his trading. He actually, something I've still avoided, but he's made a lot of good money with Doge, which is another ridiculous one. And he uses Robinhood. I use Robinhood with my sister for her trades. But me personally, I have a Robinhood account, but I don't have any money in it. I'm already too spread out with all the different things I like to trade. But anyway, yeah, so that kind of covers what I wanted to talk about. Like I said, for those of you that are in here, maybe that follow me on Patreon, I think that these two trade ideas give you a perfect idea of how I'm managing the market right now, which is, I look at the market right now as not giving, there's a very high probability that we're not going to get what we want. And so what I've been doing is I've been looking for trades that are probably not going to work, but they're not going to give me an entry. And if they give me an entry, that means they're probably going to work. And so what I was looking at was looking at this rotation, right? What areas are benefiting from a vaccine? And so one of the areas is entertainment parks or theme parks. And so we're looking at SeaWorld, and we're looking at it, but we were only going to enter the trade if it was able to break this channel, which was likely only going to happen if the market rallied. And since the market hasn't rallied, we haven't got an entry signal, and this trade really isn't going to play out until we actually get a break. Once we see a break of that channel, there's a very good chance that market conditions are going to be more favorable. We did the same thing with Vail Resorts, where we were looking for this to actually break the momentum. And we're not going to enter this early because we understand the prevailing market conditions are working against us. And so that's kind of the way I've been trading, not just this week, but the last month, is I will look at stocks and I will put out a scenario where the chances of that scenario working in our favor are probably only about 10 or 20%, but we're not going to enter unless that 10 or 20% occurs. And if that 10 or 20% occurs, well, then we have probably a 70% chance of a successful trade, right? And if it doesn't occur, then we don't take a trade and we just don't do anything for the week. And so, that's how I've been navigating this market. And like I said, just pay more attention to the cryptos. Now, it could be that Bitcoin pulls back sharply, and I start to see big corrections on a lot of these cryptocurrencies, and that pushes me back into the stock market. And if that's the case, well, then maybe we'll see more scenarios play out where we get better trades, or maybe I move towards options trades because it looks like we're going to chop and there's more premium to be had. But that's kind of why we analyze these markets and why I try to give you guys an idea of what I'm expecting to happen. It's not necessarily to trade the S&P 500 or the Dow. It's more to gauge what kind of environment we're in and how we want to go ahead and structure our trades. All right, so I hope that helps. Sam, before I leave, I'll give you the Discord link. Those of you that are in here, thank you for attending. If you have any questions, you can always reach out to me on Twitter at Stock Darts, and I'll be more than happy to help out and give you whatever I feel my read on or take on a chart is. Um, I'm gonna type it into the chat tab, okay, Sam? But like I said, no one has been in there in a week or two, I think, or more. So you're probably better off just DMing me. But anyway, that's the Discord link if you wanted to rejoin it. All right, so have a good rest of this week, guys. And like I said, just reach out to me if you have questions or something happens in the market that you're kind of not sure about. Other than that, hope you guys have a good rest of the week, and we'll meet again next Wednesday.